You saw it here yesterday when we covered the Federal Reserve decision. The Fed hiking rates, fourth time this year they've done so. Investors seemed disappointed that Jerome Powell, the chairman, was not as dovish as maybe they had been hoping. So some are still blaming the Fed for the selling that continues, at least one of the factors. However, Treasury Secretary Steve Mnuchin exclusively with Stuart Varney on this network earlier today saying investors, if they feel that way, are overreacting.
I think the market reaction is completely overblown. And, if you look at the U.S. growth versus Europe versus the rest of the world, the U.S. is still going to grow significantly higher. You look at a slowdown in China and the emerging markets. So we continue to see, when I speak to businesses, I still see a tremendous investment dollars coming into the U.S., people investing in the U.S.
I'm joined now from Fairfield Strategies, founder and managing partner Katie Stockton, Kingsview Asset Management Chief Investment Officer Scott Martin, who's a Fox News contributor, also joins us from out in Chicago. Oh, boy, now we're down 520-something. As soon as Scott Martin's face came on the screen. Yeah, you're right. No, I was on already.
You started it.
Yeah, no, it's a mess. Katie, we're going to talk about the technicals of the market with you in a moment. Scott, to you first on the Mnuchin comments. He's basically, and he's done this in a couple of interviews this week, most recently with Stuart, he's blaming the computers, right? He's saying it's the algorithms, also the Volcker rule to some degree, which doesn't allow the banks to kind of trade with their own money. But he says that's what's to blame for all this volatility. What do you say?
I think that's some of it. I think he's got a point there, but all those other points just don't make any sense. I mean, sorry, Steve, we're on this first name basis, I guess, now with he and I, because, like, it doesn't matter if the markets are overblowing it or not. You know, it doesn't matter if rates are too far down in the last, say, 3 months amidst a Fed that has been hawkish, because guess what? It is what it is. I mean, that's reality one way or another. So the markets are telling us something. And I think the data, this is the scary thing to me, Connell, is the data is telling us something, too. Look at home builder sentiment. Look at average home prices. Look at consumer sentiment. Some of the other inflation data that the Fed is supposedly supposed to be following is softening. And so those data points alone should be telling the Fed, hey, just take a pause. Hang out here. Be data dependent. Do what you're saying you're going to do. And instead, they hike rates yesterday. It's unbelievable.
It is interesting. I know a lot of people are upset about that. And Katie, to Scott's point, kind of the market is doing what it's doing. And that kind of brings us into your world, the world of technical analysis. I know Neil had a good interview in the last hour with Peter Elias where they were talking about this as well. But down we go, 600 points now in the Dow. If we flip it over, there it is. Look at the S&P 500, 2450. So that's broken through some pretty important levels, right? Tell us about it.
That's right. So recently we saw a breakdown below important support by the S&P 500. That suggests that it's more than just a corrective phase or more than just a pullback, something more significant from a momentum perspective.
What was that level?
I was watching 2640.
Wow, okay.
Right. So now it feels like ancient history, doesn't it?
That was a long time ago there. So.
And to the point about capitulation, I don't think the market always needs to have that kind of capitulative action at lows. And yet sometimes you do see that where volume spikes a bit, and I have a feeling we're seeing that today. And what that tends to reflect is that emotions are running very high, and there's plenty of news, of course, out there to
and nobody knows what to make of half of it, which we could talk about in a second. But to just follow up quickly on that point that you're making, if we close where we are, we're 2453 right now in the S&P 500, which is usually what the technical analysts look at, more say than the Dow. It's a broader measure of the market. What does that mean? What does that tell you? What's the message?
There's another support level that is being tested as we speak by the major indices. So we always look at these levels as cushions, not exact, precise points.
But where's that about?
Around 2510.
Okay, so above where we are now. So bad sign if we close here, technically, bad sign.
We want to see the market come back above that level by the end of the week. So by Friday's close, we want to see a return above that 2510 level, and that would help preserve that next support on the chart. Below that, you're talking about 2240, and that's where it gets a bit dicey.
As if it isn't already.
Right.
All right, Scott, let me go back to you then on some of the factors. So to Katie's point, there's a lot of news either to talk about or speculate about. I think the speculate part's really the problem here, right? We can talk about the Fed, and you already did, and I get the point on that. But if you think about all of the news items here, what single factor is creating more uncertainty than anything else right now? To me, it's got to be the president. because he's the one who's connected to all of these news items, even the Fed in going after Jay Powell, but certainly on China trade, certainly on the government shutdown, and on a whole host of other issues, whether it's the Mueller investigation, which is coming after him, and all kinds of things heading into next year. Is the President of the United States, in many ways, at least to me, and maybe you disagree, that's creating the uncertainty. I know he likes to take credit for the market when it's on its way up, but what do you make of that?
Yeah, and he's been eerily silent the last couple of days. And you're right. I mean, Mueller was one thing I was going to say, Connell, that's out there that's kind of looming over this market because we don't want to see any more instability on that. So, yes, unfortunately, while maybe the president was a buttress to the market, say, when he got in office and with the tax cuts and all this pro-business rhetoric, now it's probably hurting the market to some degree. And I do like what Katie's talking about and what you've actually alluded to, Connell, is that, you know, the market can do a lot of nasty, bad things during the day, intraday, but where it closes on a, say, daily basis, weekly basis is certainly things that you need to keep an eye on as an investor because there can be some constructive closing here on some of the S&P prices. But the psychology of the market here right now is still sell first, ask questions later.
Yeah, no doubt. Down 574 now on the Dow. Katie and Scott, thanks to you both. We appreciate it.